Okay, so thank you all for coming today. My name is Avneet Guman, and today we will be, Fordham Private Equity Venture Capital Club will be introducing our keynote speaker today. His name is Kunal Mehta, and he is currently a principal at Hearst Ventures, and he has authored two books. Kunal's most recent book, which is Finding Genius, and which we have given out free copies to many of our audience members, is based on over 2 years of interviews with venture capitalists who first invested in companies such as Uber, Airbnb, Tesla, Twitter, Pinterest, SpaceX, and others. With a focus on creating a more diverse perspective, the book Finding Genius also invites several emerging VCs from different genders, socioeconomic backgrounds, and geographies to write their own chapters on specific verticals of interest to entrepreneurs. Kunal's book has been featured in JP Morgan, Harvard Business School, NYU, Columbia, and other conferences and universities. And of course, our guest of honor today, Kunal, a little bit more about him. He is currently a venture capitalist, and he is currently a principal at Hearst Ventures, and he has also authored another book previously called Disruptors. Kunal first began his career at JP Morgan as part of the Smart Start Scholarship Program. He then left Wall Street in order to join the nonprofit Charity Water, where he helped support the clean water initiatives in East Africa. Kunal then launched his own startup, Unfold, and raised venture financing for that operation. And during these seminars, Kunal does tend to speak about his experiences and really is focused on building the tech and VC ecosystem amongst students through his book and through his research and work. So we are really pleased to have you all today, and we're really pleased to have Kunal here today. So yeah, definitely. Thank you so much for having us today, being here with us today, Kunal, and we'd like to give you a round of applause. So
thank you. Good evening, everyone. I appreciate you all taking the evening. If you're willing, I'd love to turn this more into a discussion and a conversation. So if you are willing and you're not wearing your pajamas, it'd be great if you just turn your video on, and then we can kind of keep the conversation going that way also. But if not, totally understand. I've been there before. But I was thinking what I can do to start off the conversation is just quickly go through my background, some of the decisions I made with my career. And it's really nice to be here in front of MBAs, which was also a decision point for me too. And I'm maybe not smart enough to get into an MBA program, so it's great to be here talking to you all. So I'm looking forward to learning from you too. What I'm thinking of doing is maybe I'll just go through my background quickly and then open up for any conversation and questions you have or areas you're focused on right now, and just a broader discussion around startups, around venture investing, around the publishing industry, around charity water and impact work. So there's different areas that we can touch on. But just to flash back a bit, so I had began my career at JP Morgan as part of a 4-year scholarship program. I'm from Brooklyn originally. And the scholarship program was basically saying that I could go to NYU, the Stern School of Business, on a full scholarship, but I had to work for JP Morgan for the 4 years while I was there. That was an interesting offer, and it seemed like a great position to be in, where you're working at JP Morgan between 2007 and 2011, in starting off in kind of back office Treasury Security Services, and then slowly moving into investment banking. And learning a lot about the industry and seeing how the inners of kind of the different groups and divisions work and some of the deals that they were doing. It was an interesting time, but also kind of turned into one of the greatest recessions that our generation had ever seen while I was there. And that was not caused by me. I was not doing anything with mortgage-backed securities. But we spent some time kind of in the different groups, learning about them and figuring out exactly what I was interested in, while also at the undergrad business school at NYU. And pretty quickly realized that this wasn't work that I was that excited about. I wasn't that interested in it. I wanted to learn more about technology and building companies, and kind of most hopeful and aspiring college graduates are also thinking about, okay, what is the big business that I can build, and how do I quit this job and start a company and then sell it for $1 billion? So I think that was a thought that most people were having, unfortunately, at that time when kind of the startup movement was sweeping New York. So I ended up leaving Wall Street after graduating. I spent a year in equities trading, and then left without much of a plan. And the process of that decision was more of, I was seeing people younger than me and people around me who were building companies and starting them and actually finding pretty decent success, like where they were going to work every day and building something that was interesting. So I was only seeing more of the rosy side of building a startup at that point. Ended up quitting, trying to figure out what would be the next step. And what I realized is that in the first 6 months of leaving my corporate job, I was trying to figure out what would be those early failures that other people who had left their secure corporate jobs to start up companies had faced in the past. And went out to have these conversations with founders who were building companies now. So I ended up speaking with the founders of companies like Pinterest and Foursquare and Betterment and Dwala, a company called LearnVest, which was recently bought over. There was kind of early executive members from Airbnb and Twitter. There were members of a company called Gumroad, and then also the founder of a nonprofit called Charity Water. So I did about 50 or 60 different conversations, and it turned into the first book called Disruptors, which the premise was, what are those first 6 months of when an individual decides to leave their corporate job to start a company? And how do they raise early financing? How do they explain it to their significant others of, I'm deciding to go and do this, and I won't be paid for the next 3 or 4 years to do it? How they tested their products and how they thought they would be onto something. The founder of Gumroad had actually given up almost all of his equity in Pinterest in order to build that second company. So the decision process behind that, I'm sure he's kicking himself based off of the performance this year. And so it was several interesting, more candid conversations as opposed to focusing on the final stages of a founder's journey when they've already succeeded. We read about the kind of quarterback wisdom. So that book was published back in 2014. I ended up joining a nonprofit called Charity Water at the time. Charity Water was a few years in, but the mission of the organization was to provide clean and safe drinking water in developing countries. So it was pretty juxtaposed to the work that I was doing on Wall Street, but I still joined in a finance role. The CFO had also left a private equity fund. It was more of a driven nonprofit than kind of what might be perceived in this room as the slower moving, a little bit rusty, less brand friendly. But if you look up Charity Water, it's really backed by kind of top venture capitalists. It's backed by top entrepreneurs. Jack Dorsey, Chris Sacca have all poured money into the nonprofit with that mission of providing clean and safe drinking water in developing countries. And the way they do that is by funding NGOs and other kind of clean water initiatives and organizations in developing countries. So my focus while I was there was primarily East Africa and Ethiopia. And I spent some time in Ethiopia, and we did a visit to the field where we saw kind of what life without clean water looked like, where we had driven for 5 or 6 hours, and we would spend some time actually in the field after making one of those grants and seeing the water being the well being dug. And it was a really interesting experience. It gave me a taste of kind of building product at an early stage startup and seeing what that was like. At the same time, the book ended up taking off, so I left Charity Water after a few years with the CTO, and we launched our own product called Unfold. We raised about $1 million in financing for it in seed stage. We had a soft exit per se after a year and a half of doing it, but I consider that company to be a failure. We learned a lot about building a product, putting an app on the App Store, getting customers, getting them to pay for it, building partnerships with a lot of the big publishers. So happy to talk about that too, and actually being on the side of raising venture financing. But given this is the PEVC club, I'm guessing most people here want to talk about venture capital and learn about that more. So for the last 4 years, I've been doing venture capital. The last 5 years now. The first 2 years were through NYU's endowment primarily. So we were investing in the seed stage for PhDs, postdocs, NYU alums. We were investing in companies like Brooklyn and OpenTrons, VidCode. Some have gone on to do pretty well. But more, I think what's probably more interesting for this conversation is for the last 3 years I've been with Hearst Ventures. The first 2 years of that were focused primarily on transportation and mobility. And the last year has been more on healthcare focused investments. We'll typically do Series A through C investments, anywhere from $2 to $10 million. They don't need to be strategic to the Hearst Corporation. The Hearst Corporation's diversified quite a bit over the last 25 years, where it's not only media focused anymore, but we're actually, there's kind of 3 distinct verticals, one within financial services, one within healthcare, where on the financial service side, Hearst actually owns Fitch Ratings. It owns and operates that. On the healthcare side, Hearst owns and operates about 8 different businesses. And then the final vertical is this transportation and mobility piece. So we can be strategic in kind of the areas of where we invest. They don't have to all be media focused, but the first generation of venture investments that the team made were in companies like Roku, Pandora, SiriusXM, BuzzFeed. There's several kind of prominent media companies that they've made. And in the second generation, we've done more logistics, shipping. They've also invested in Via at the early stages. And then I've been more focused on the healthcare side more recently. So happy to kind of share some thoughts around that as well. While at Hearst, and the book that you'll all receive is something I had started working on about 3 years ago, and I published it back in October. It was a book called Finding Genius. And the premise of this book was similar to Disruptors, where I now focused on interviews with the top VCs who had backed Uber, Airbnb, Pinterest, Tesla, kind of Facebook, Snapchat, a bunch of the top technology companies to better understand what they saw early on. So what did it look like when that founder was just getting started, since many of these were seed or Series A investors into those companies, and what they were trying to better understand about the company or the growth trajectory or the opportunity that they had, and how they evaluated those opportunities early, and some of the failed investments that they also shared more about. But what I realized in writing that book was that despite my best efforts, I was speaking with VCs who all represented the same kind of geographic breakdown between San Francisco and New York, the same kind of socioeconomic background. Many of them went to Stanford, or many of them came from wealthy families, had family offices behind them. Many of them were the same gender or the same age group. So it wasn't a very diverse perspective in the first few chapters of trying to hear how they define genius per se. So what we did then is the back 10 chapters are written by an emerging group of VCs who represent different backgrounds, different genders, different races, different kind of just different perspectives on the entire landscape. And they went deep into focus areas that they've been building for the last 3, 4, 5 years as venture capitalists. So one of them wrote a deep dive into healthcare, because she spent most of her time there. One of them did a deep dive in artificial intelligence and human health, as he's made several investments there through Two Sigma. Another went deep into blockchain and made introductory statements there around where she was investing at the time. So the book is structured as the kind of the old guard of VC and some of the thoughts that they've shared in terms of areas they're interested in, investments they've made. And then the latter half is structured in more in terms of this new guard and these emerging VCs, and excited about. So obviously started a book tour in October of 2019, but that all fell apart pretty quickly. So here we are now. We're doing a book tour over Zoom, and I'm glad you all. I know you're spending most of your time on Zoom and sitting in classrooms, and it's probably been extremely miserable and not the reason why you decided to get your MBA. So I empathize with that, but I appreciate you still taking up your evening for this and having a conversation around it. So that's kind of just my quick overview and my quick spiel of some of the areas where I've focused on and where I've spent some time. And I'd love to keep this conversation very candid. So feel free if it's questions about recruiting for VC jobs, if it's questions about thinking about how to raise for your startup, if you're thinking about building a company, I'd love to just take the discussion in any way that you'd like and what would be most useful to you. So we can have a candid conversation there. And I'll turn it over to you guys if there's any questions.
Awesome. So thank you so much, Kunal. So if you guys have any questions, you can just kind of put it in the chat and we can circle back. So Fordham PEVCC, we have so many questions for you. One of which is, kind of starting off with a personal question. You said we might not take an interest in just your prior experience to VC, but we are. What made you take the leap from Wall Street to the startup life and then the VC life? What were you seeing firsthand that maybe we haven't had the experience to see? Did you see greener pastures? What was really on the horizon for you when you decided to walk away from Wall Street?
Yeah, sure. I think at that time, I think this is also probably pretty naive, but at that time when I was on Wall Street, it was 4 years in as an undergrad. So I was working, going out on Thursdays and then having to work on the trading desk and be there by 6 a.m. So I'd hit this point after 4 years of being pretty burned out by the work. And it was also between 2008 and 2011 when kind of a lot of the public perception around Wall Street was sort of like big tech now, where you were vilified and people were like, how could you actually do this as a career? The business school that I was in, which was Stern, was also very focused on building you towards a career on Wall Street. It was investment banking or bust. So kind of being in that structure, there was very little room for creativity and kind of thinking about what it is that I want to spend the next 50 or 60 years doing. And as I was doing that job and I saw my managers, there wasn't really a role that I was that excited about. It seemed very kind of financially driven with many of the decisions that I was making. But I was fortunate enough to not have the student loans given the scholarship. And I was also realizing that bonuses may not be kind of similar to the way they had been in the past. Obviously, that's changed and things have bounced back, where the financial equation had sort of changed at that point. So I was thinking of like, if what really drives me and what gets me excited, and when I was outside of JP Morgan was more around, I want to see if I can build a company for myself. And I had tried to do that 2 or 3 times. There was this aspirational hope of what would it look like to actually build a company on the side. And that was sort of the premise for Disruptors, where I realized that I had no idea actually what those first steps look like. When you do decide to leave that confines of a secure job and someone telling you what you do and you have a secure paycheck coming in every 2 weeks, that was the premise of that, of people who had left consulting or banking or law or kind of different firms. Actually, one of the people I interviewed was also Andrew Yang, who was recently presidential candidate, who left a job in corporate law in order to start a company. And so the decision to leave Wall Street was very much based off of that. It was aspirational, thinking about what else could be good out there to work on. And at first I was looking for jobs in startups, and then it slowly switched into, when I left, I started freaking out. And the first 3 months was much more like, okay, every 2 weeks I tried to do something. I would have nights where I'd come home and be a bit discouraged after a meeting where someone would tell me, my parents introduced me to someone who was supposed to be an advisor, and she told me, call your boss up and ask for your job back. And I think it was pretty shocking at that. So there was nights where I was pretty discouraged by what I was doing, but when I stuck it out, then I realized that it was the right decision, because at Charity Water, I ended up learning quite a bit more about building product and kind of releasing a product and raising financing. And I think the end path of being in venture capital, there are people that make that shift by just being in banking. But I think it's worked out well for me, where now when I'm talking to a founder, I can empathize a bit about what it's like for them on a day-to-day grind, as opposed to just being in the financial model and thinking about their business.
It seems like that experience was really crucial to you, understanding the entrepreneurial mindset, and it seems like it was kind of the foray and first steps for you into VC. And
Right.
yeah, so a lot of our students, they definitely do want to make that leap to entrepreneurship and VC. One of my questions that I had from your intro was really, we don't see what startup founders look like early on. And what were the differentiating factors between the successful founders that went on to have unicorn success versus the startup founders that you saw early on and were observing that did not have that same level of success as, say, Tesla, Uber? Yeah.
Right. That was interesting, actually. The first book was much more focused, I think, on the candid, because it was happening in real time. I think with the second book, it was all interviews with VCs that had already succeeded and they had already found their companies, and those had done well. So they became household names. With the first one, it was interviewing the founders of Betterment right as he was getting started. And it was 4 people. He looked exhausted. He looked like he hadn't slept in days. He didn't really know if it was going to work out. He had also left a job in investment banking. So he was saying his wife was a little frustrated because they had a kid. They were just trying to figure all that out. And now I think Betterment's valued at like over $2 billion or something. But so I was doing it in real time, where it was the founders, this one group of companies that has gone on to do really well. Some have just gone completely flat. Some peaked. There was a company called Policy Mike, which I think at last round had raised at a valuation of $750 million, and it declared bankruptcy, I think, about 2 years ago. So they went away completely. But talking to that founder and talking to him over the next 5 years after that was just extremely inspiring. But I think the qualities that really stood out in the test of time, kind of 7 years after writing that book, are the ones that, and even doing this, and then talking to the venture capitalists about how they define genius, is more of that: who's got the staying power to stick with an entrepreneurial endeavor more than a year. And I think that's the hardest part, and something that I didn't have. So when I was trying to start a company, at the end of the year, I was like, okay, I'm ready for a paycheck. I'm ready for more stability. I'm ready to go back into a situation where I know this promotion is coming, or I know this is what I could be earning in 5 years from now. Where I think a lot of the entrepreneurs that ended up doing well realize that it's not going to take a year. It's not going to take 2 years. It could take 10, 12, 15 years in order to build a company. And you'll see a lot of fits and starts with that, where on your third year, it looks like you've conquered it and you go and raise your massive Series B. And then you struggle to raise that Series C because investors just don't get it, or you haven't hit those growth metrics that you really needed. But I think the real entrepreneurs who have stuck with it, and that staying power and that resilience of kind of going through a wall, going under it, going over it, figuring out exactly how to go about it, are the ones that did really well. On the venture side, the ones that we'll typically fund are the ones that also are very good at telling their story of why they're launching this business, how has the product evolved, what is the pain point that they're solving for their customers. So then they're very good storytellers too, are the ones that end up lasting, because they need to be good storytellers in order to recruit people to join them in their vision. They need to be able to convince investors that here is my linear thought process of how this company continues to evolve and do well. And you'll be surprised that no matter how much founders practice it, they just still cannot communicate what they're working on. And you'll spend an hour or listening to them and talking to them, but you still, at the end of it, you don't fully understand what it is and what's the pain point. Why are you building what you're building? And I think the founders that have really nailed that storytelling piece actually end up being pretty competitive when it comes to raising venture capital. So I think that resilience is a big piece. Being a good storyteller, I think being a good recruiter of people, and actually, I think being a little bit nonconformist, of having kind of those original thoughts, and also not worrying so much about when other people are kind of ridiculing what you're working on and why you decided to do this. I think that's a hard dynamic in business schools. I mean, we saw it at NYU Stern. I'm sure maybe you'll see it in your Fordham program, but building a company has gotten destigmatized to the point where maybe it's actually a little too destigmatized. But before, if you were going out to build a company, people did, okay, is that the smartest decision with your career? So now I think there's enough of folks being able to have some the wise vision. This is how I'm going to do it, and this is the structure that I need in order to go after it. So I think those are three of the pieces that have kind of separated some of the founders that we've spoken with.
That's really, really interesting. And another thing about you and your team, and kind of based off of what we're looking towards. So we're in a pandemic. The pandemic has gone on longer than we expected. We just got a vaccine. It just started rolling out, right? So I know you've heard this question many times since the pandemic started, but what are the areas of focus for your team, the new areas of focus for your team, and the new technologies that you're evaluating? And are you kind of taking on an impact-driven investing thesis this time around, considering the situation we're in?
Sure. Yeah. Interesting. So what was surprising is when the pandemic started, I think we all sort of kind of pulled back a little bit, and across the entire industry with other venture capitalists that I was speaking with, everybody was like, we are not going to deploy any capital. It was March, April timeframe. I think going into the summer, even as late as June, July, it was still very slow, where I think a lot of people were just nervous. They didn't know where things were going. And I think as the stock market started going up, and as sentiment started going up, and realizing that there was just so many large funds that had been raised over the last few years, a lot of these venture capital funds still had money to deploy. And there's a small business survey an SBA survey, where I think there was more founders that were actually going and building companies. Those that probably started building companies during COVID have probably not been funded yet. But there were enough being started in the last few years, and enough venture capital funds have been started where that match was still there. And things picked up in a very big way, kind of June, July, August, where this has probably been one of the most busy Decembers that we've had as a firm, with several deals going to committee and kind of working through some of those. And across the industry, we're just seeing more and more announcements. And I think that's changed also because of the public markets, where the kind of the emergence of the SPAC, even though it's a kind of an older concept, but we've just seen more companies going public. So more internal kind of portfolio companies also considering exit opportunities. You've had more kind of older companies see their businesses accelerate as a result of COVID, given they're all technology based. We've seen some companies struggle because of COVID, but then have their businesses bounce back and then get into a more strong position for fundraising. So I think consumer sentiment around technology businesses has still been there, and it's been there in a big way, where kind of venture funded businesses have continued to do well. Like live events businesses have struggled. We've seen kind of retail businesses struggle, but the digital, as long as their digital channels built out, those did well. The area where I'm kind of primarily focused, and I can speak for the broader team, but we have some investing in media and consumer businesses. We have some investing in transportation and mobility, logistics, shipping, someone investing in financial services and insurance. And then we also have a team in China and Israel and in the UK. And they've all seen these same dynamics play out as we have here. And they have their own focus areas. But where I've primarily been investing is healthcare. We looked at kind of several companies, and obviously healthcare has changed pretty dramatically given the pandemic and kind of what sort of businesses have taken off. Many of them in telemedicine. So digital health as a large vertical has kind of continued to perform and exceed expectations, and it's dialed up consumer adoption, where in the past consumers were less willing to share these things kind of over a phone and wanted to be in primary care. So we've seen more of these text-based apps, Galileo, K-Health, kind of primary care, people discussing their symptoms over the phone continue to do really well. Telemedicine as a whole, other areas because of the pandemic, so we've seen these therapy startups being funded, and it's continued to be interesting of what areas will emerge out of this. I don't think we're going to take that impact lens necessarily. I mean, I think we look at it more as if the consumer cares about the impact that the business is generating, that's going to feed through to the metrics, and that's going to feed through to us as we make an investment. But we're not an impact fund first. We're more in it to generate alpha and returns for the organization. But I think that's always something that the Hearst Corporation has cared about. So if a business is doing well, all things equal, those are the businesses that we care about and investing into. So we're not going to invest in the ones that are a bit on the fringe of maybe dragging the Hearst name and the family name, which has typically been very philanthropic, in investing in businesses that wouldn't be supporting the mission where they stand at the corporate level. So we are seeing businesses in healthcare that are creating a positive impact, but it's not necessarily an investment decision. It's more important on the metrics and the financials, where the business model makes sense before we make that investment.
Yeah, that makes a lot of, yes.
I see a question in the chat, so I figured I'd just answer that one quickly. Just to read it out, we're hearing a lot of news lately of startups and companies, for example, Elon Musk and Oracle, moving out of the Bay Area in favor of more affordable locations such as Austin and Miami. As a result of COVID. Given that New York is one of the most expensive places in the country, do you think this trend of entrepreneurship capital companies shifting to more affordable locations will affect the city's future as a rising startup hub? So I will drop something else in the chat, but I'm doing these video series interviews with VCs and founders, so you can feel free to follow along. But the one that I just interviewed, which I thought was really interesting, is a GP named Keith Raboy, who is with Founders Fund, and he has been the most vocal on Twitter and across the board about the move to Miami. And he is actually like actively recruiting a lot of Silicon Valley and startups to move out to Miami, introducing them to the mayor there. I actually don't think New York is going to struggle. I think the system has been built in a way where you have access to the top fashion companies. You have access to, there's a fund in New York called Workbench that introduces them to the top banks, the top consulting firms. So you have so many different industries incorporated and kind of set up here, where that if you're a founder, you have access to all of them just to purely make sales. I don't think that, I mean, Austin and Miami are great places to live. And I think if you're a founder in the early stages, you should definitely go there. But if you're building a B2B business, you want to be where your end client is. So a lot of the larger software businesses that we're building in the Valley, I think will continue to stay. If you're building a consumer business, you can really build it from everywhere, anywhere. And I don't think that Silicon Valley was really offering a unique advantage to them. But as a founder, I think you really want to be in the hub where you can sell to the customer. I think capital has now become pretty commoditized. So the question about is access to capital going to shift? I don't think that's going to be an issue. I think over Zoom, we've gotten more comfortable making investments. So if a founder is building in Miami, it's not going to be hard right now for me to consider making an investment over Zoom. And in the future, it's not that hard to catch a flight. So before COVID, I was looking at deals all over. And one of the first investments we made was in a company in Chattanooga, Tennessee. And it's a company called FreightWaves. And that founder has been recruiting people to Chattanooga just because the cost of living is so low. So for employees to go there and running a business over there can also be much cheaper. So as investors, your capital goes a lot longer. So I think it's become more democratized in order to build a company. You've seen more startup hubs, but I still think all locations aren't created equal. I think it's important to be wherever your customers are. And if those shifts continue to happen, then it's gonna be interesting for startups too.
So we're going to open up the discussion to the
Sure.
rest of the audience. And I know Masu, thank you so much for that question, Akshat. We know that Masu also had a question. Why don't we also open up our mics and, ask them? Why not? Make it a little bit more interactive.
Sure, I can ask. Thanks for sharing your
Masu.
insights about venture capital. Hi,
Yeah,
Kunal.
of course.
My question is, after 2008 recession, we saw there were many companies coming up the field. And after our pandemic, and do you think it will affect the venture capital business? How everything will change? What do you think about future prediction?
Yeah, I think I guess what I've noticed more during this is that venture capital really does operate very closely to the public markets in a way where the exuberance that's in the public markets we're also seeing in valuations. So that hasn't really changed. I think some of us were buckling down, expecting that valuations would come under control again, and then now would be our chance to pounce and actually get into deals at a better valuation or a much more reasonable valuation. But that hasn't changed. So I think the pandemic has continued to accelerate that, where if these are technology businesses, they've done well during the pandemic, they're going to really see a shift in terms of valuations or how the venture capital market changes. What your first point about there's more founders and entrepreneurs that were created because of 2008, I also think the same thing has happened here, where we've seen more founders at the early stages build businesses because they've noticed an issue that maybe started in kind of the fall of last year, but then it's accelerated. So whether it's the need for telemedicine, for example, in healthcare, whether people were actually building smart devices for temperature control, for management control as you walk into buildings, for security. There have been companies that were focused on kind of just pure consumer applications. So we've seen podcasting actually go down as less people go to work, but streaming services have blown up. And so you've seen more of those take off recently, where consumer adoption has just grown. I don't think the venture capital market has been changing and shifting for a while, and that's actually one of the last chapters in the book, is more focused on what are these new verticals that are coming out. So I think last time in 2012, 2013, it was the ICOs. I think it was much later than that, actually. It was the ICOs of taking like these private companies raising money through these coin offerings. But that had gone crazy, where there's dental offices raising through DentaCoin. And then some SEC regulation came in and controlled that. And I think the same thing is going to happen slowly with some of the other exuberance around funding that's out there. But at some point, there's got to be a reckoning in terms of valuations. And a lot of venture funds right now mark up their investments with kind of new deals and showing that their companies are doing well. But the funds that have raised their first fund, as long as they're not able to show a high kind of return on capital invested, which should be called multiple on invested capital, is they're not going to be able to raise their second and third fund. So I think you'll see more consolidation over the next 5 to 10 years between the larger funds and the smaller funds, which may change the dynamics for founders raising their first check. But since I've been in the industry for about 5 years now, people have been complaining that there's just too much venture capital out there. So I don't think that's necessarily a complaint, because if you're a founder, it's amazing. You can have so many different investors and kind of a diversified board investing in your company. I think you've seen more corporates and larger pension funds investing in the asset class. You've seen internationally more funds and money pouring into it. And that's all on the backs of like that first wave of tech companies that went public. And that's going to continue. Now, Slack just raised its own venture fund, and they're going to invest in companies. The other piece that's interesting too, that for the last 5 years they've been saying, is that it's a founder friendly market because of how much money is out there. So that's also good. If you want to work in venture capital, there's more funds that are out there for you to choose from. So I think what started off as a cottage industry, which is what I describe in the book, is now much more a very accepted asset class. It's proven to have really good returns. The things that might change is you're seeing more of this Substack generation syndicating deals easily on AngelList. So some of it's going digital, but I think there's still an information edge there, and there still is a need to be able to get into the deal and find the right founders to work with, the higher quality ones, which the Sequoias, the Andreessen Horowitz, the Thrive Capitals, the Founders Funds will continue to get some of the best founders, and they'll perpetuate that because they'll just continue to fund those companies. So there's a lot of dynamics at play. I think the pandemic has dialed up some of them, but people have been calling for the end of venture capital for 5 years, at least since I've been in here, is that something needs to change and it's going to be breaking up, but not much is changing on a day-to-day basis, at least. It's a good question though, thank you.
So if anyone has any more questions, you can just jump on.
Yeah, I had a question. You talked a little bit in the beginning about how when you first kind of made the jump that you had family and friends kind of nudging you that maybe you should go back to a cushy Wall Street job.
Yeah.
Did you have to kind of give yourself like if it doesn't work in 2 years, I'm going to go back? Or how did you navigate that process?
Yeah, and that's a really good question. So I think the good part is my parents were very supportive of me like figuring it out. I think they had seen that I wasn't the happiest in that job and I wanted to do something different. So that was helpful. Don't come from a family where there's a lot of kind of money. So it wasn't like something that I could just always be like, oh, my parents will take care of me. So I think I saw my kind of balance that I had built up by working in Wall Street depleting pretty quickly. So some of the worst kind of experiences was going out for drinks with your friends at a bar and then swiping your credit card and being like, shit, like I really cannot afford bottle service, or I cannot afford a drink right now and I shouldn't be doing this. So then you slowly become a little more reclusive and you're like, I'm going to go out once every 4 weeks, which I think builds up that frustration of like, should I continue doing this? So I'd set a deadline of a year of sort of exploratory figuring things out. But I think every week and every month, like when I didn't know what that year looked like. I definitely knew I didn't want to go back on Wall Street, but random days I would see like, oh, this friend just became an associate at Goldman. And then the wheels start turning like, oh, he's probably or she's probably earning this much, or wow, their career is sort of set and here you are being a fool trying to figure this out every day. But I think it has to be some sort of discipline of like, I've decided to do this. I'm going to really see this through and figure out what the next step is. I think there were days also where I came back and then started applying to those jobs again, thinking like, hey, this could be interesting. And then when I would get the interview, I'd be like, no, I'm not going to do it. So it's a lot of flip flopping back and forth. It's not like I can pretend that I had the conviction of saying, I'm going to be true to myself and ride this out. But at the end of the year, I think what my plan was that I will try to start building something. And if I see kind of incremental successes with it, then I'll follow that. And if I meet these goals in 6 weeks, then it means I've bought myself another 6 weeks to do it. If I didn't, I need to be honest that it's time to scratch it. I think the goal was always to join an early stage company if I wasn't doing something on my own. It was never to go back to Wall Street, because the idea was that if I join an early stage company, I'll get some upside with them, and then I'll also learn about how to build a company from them, and then can try to do it again. At that point, I never thought I would go into venture capital. The thing was to, how do I get smarter at building a company and perhaps launching one? And then the entry into venture capital was always, this is a great place to be, to see the other side of the table. But then really just started enjoying the career where now I've just been doing that. If that's helpful, kind of to what you're guiding for. But if you're thinking more about how do you, if it's something you're doing, I'd love to hear more about it too. If you're thinking about launching a business or leaving something secure. But we can talk offline also. You can reach out whenever you want.
I think Jay also has a question.
Hi, Kunal. So you talked earlier when you quit Wall Street, you were working in Africa for the Clean Water Initiative. So
Right.
like just relating to that, some people say water is a new investment of the future. Like maybe 50, 60 years is going to be better, like bigger than oil. And
Right.
so where does the VC world connect with that? Like, is it really interested in water investments as of now? Or is it thinking, oh, it's going to be something in the future, we'll think about it? Because they found this thing in Central America, I don't know what it's called, but a lot of companies are investing and trying to take a stake in it might be the biggest reservoir in the world for water, fresh water.
Okay. Wow. Interesting. Yeah. I mean, I think so charity water was much more impact driven, and it was much more sort of base of the pyramid. Like, let's think about how do we just get access to water for people who have never had it. And that's purely for drinking, for bathing, for cooking, for children who are kind of more rural areas going to school and then getting dysentery and diarrhea and all of those right now. It was less about what does the future in 10 years look like? It was more, let's provide, if everybody in the world could have access to clean water, what does that look like?
Okay.
I think the venture capital piece, yes, is probably more resource constrained. It's how do we invest in new technologies and businesses around that. Charity water was more leveraging the technologies that have been built. In one example, Charity Water had done actually a partnership with Google, where Google was putting $5 million in for us to figure out this sensor project of when you build a well, can the sensor measure the flow of water, how much water actually flowed out to the people, and if the water table at the bottom was depleted enough, where then you need to replace the well itself. Because that was one thing that was broken in the industry, where if a well was broken and water.org or someone had built it, if it broke, the village was now left without clean water again after becoming reliant after 2 years. So that was the project and technology they were building. I think on the venture capital side, I don't do that much investment in kind of clean water and clean initiatives and things like that. There is someone on our team that's more focused in thinking about that. They're more focused on kind of software plays of how does a government manage water depletion, or how do they manage environmental damage, or how do they think about the flow of utilities and facilities and change time. These are more software driven businesses. Venture capitalists, I think, won't typically invest. They have an aversion at a broad basis towards hardware. So any of the new devices to water filtration and things like that, we've seen companies pitch, but they have a hard time raising. Kind of for more technology focused VCs. There are funds that do focus on that. There's a fund called Bolt that focuses on hardware. But like a water reservoir in Central America would probably not be a venture capital investment. It would probably be more of a private equity kind of clean water fund. My friend works for a fund called Capital Dynamics, and that's actually kind of a clean energy focused fund that invests in these infrastructure projects, kind of similar to what you're talking about, but they'll invest in windmills for a 10 to 20 year hold period and then sell the power that's generated. So a clean water reservoir, I'm guessing, could be something similar, where then you have the asset there in the water itself, and then how do you manage that and think about the cash flows that are generated off of it. So you can look into Capital Dynamics and can give you his name to, if you want to be introduced or talk about it more.
Thank you, Kunal.
Yeah.
I have a question.
Yeah.
Hi, first, thank you for being here today. And my question is about Bitcoin. And
okay.
I know it makes headlines every day. And recently, Elon Musk said, to move their large transactions to
Right.
Bitcoin. What does
Right.
that mean? And second, is venture capital, how are they looking at Bitcoin?
So I think venture capitalists, so on your first point about Elon Musk moving it to Bitcoin, the reason why Bitcoin, I think, is going up in value, and the reason why some companies are continuing to keep some of that on their balance sheet is the same way they're just diversifying away from currencies that are backed by governments. And the reason they're doing that is because they believe, given the pandemic and given actions that have been taken over the last kind of 10 or 15 years, currencies that are typically backed by governments are going to be devalued. They're going to become sort of useless because there's just so much money being printed and there's an infinite resource available. It's not really based on a gold standard anymore. So there's going to be hyperinflation. And as a result of it, there's digital currency that's easier to use. It could be meant for more digital transactions, and kind of there's a new world that we're living in. If you're especially able to start making kind of purchases with it, if it becomes more mainstream, that's going to become more valuable. So when Elon Musk, I think, is moving many of his transactions to that, and I have to read into more of this, is saying, let me diversify away from fiat currencies. And I think he tweeted something like, the only thing that's BS is a fiat currency or something. So I think that's what the goal is to diversify away from fiat. If it's all in US dollars, and you now have less faith that the US dollar is going to continue to have that strong power that it used to, then you can diversify into some Bitcoin. So I know Square did that as well, where they, I think, put 500 million of Bitcoin on their balance sheet to hold it going forward. It's still extremely speculative. And I mean, we saw this in 2017, 2018, where every VC was tweeting about it and talking about it, and every single person that owned it was being like, I'm the richest person in the world. But then from 20,000, it went right back to, I think, 4,000 for a couple of years. There's still a lot of faith in it. I still have a lot of faith in it, I think, but it's gonna keep seeing major pullbacks and keep going up higher. But I think that's the reason it's making the press, because it's such a speculative thing. The same reason why Tesla stock price goes in there, because there's people becoming very rich off of it. In the VC space, I think there's less focus on just Bitcoin itself. I think it's more on the technology and whether blockchain can be useful in different applications. At Hearst, we had done a deep dive into the space to figure out whether we want to start doing more blockchain-based investments. But then what we realized is that we would rather understand how blockchain works, but then become sector experts in healthcare, sector experts in insurance. And then if someone introduces us to a company that's built on blockchain, that tell us why it needs to be built on blockchain as opposed to any other technology stack, then we better understand why that's relevant, as opposed to just saying, okay, we're only going to exclusively invest in blockchain companies going forward. You've seen several companies that have built on blockchain do really well, but I think it's still something that there haven't been a lot of exits yet, but I think everybody sort of agrees that this could be as important as kind of the internet and Internet Explorer and all the businesses that came as a result of it. But I think it's still in its infant stages, and it's been in the infant stages for a few years. So it'll be interesting to see how that all plays out. So we see companies that pitch it, but I prefer the companies that don't lead with it, that we're a blockchain company. It's more like we're a company that's doing X, Y, and Z. These are the problems we're solving, and the reason why we can do it so effectively is because of blockchain. So that's sort of what we're looking for more with that.
I will follow up on that. So for the Bitcoin, so my thinking is, okay, yeah, this is all great, but for us, it is still always been so expensive. How can it become mainstream? What would that mean?
So I think what'll probably happen is that you can buy fractional pieces. So you don't need to own a full coin at whatever it is today. I think 24,000 or something.
Mm-hmm.
So you can buy fractional pieces of Bitcoin, and that could be traded upon. I think what will probably happen over time is that the price will stabilize as it's accepted more into mainstream through companies putting it on their balance sheets, through companies accepting it for transactions. So when you go to the coffee store, you can now pay in Bitcoin, but you can pay in that same Bitcoin when you're in Europe, or you can pay it in India, or whatever country you're in. If it becomes more mainstream like that, where people start transacting through Bitcoin. And I think when all the coins are mined, which I think that's still in process, then you'll start to see a little more stabilization as well, because there's still this allure of developers pulling out the coins and miners pulling out the coins. So you see the price changing. given it is a speculative product, I think that's also what happens. But you see that with new companies that are released. So right now there's just more speculation across, I think, all asset classes and industries. But with time, I think these things will stabilize too.
Got it. Thank you.
Okay, so I'll just jump in here. First of all, thank you for taking the time. I really appreciate it.
Yeah, thanks.
And you mentioned earlier in the chat something about in a pitch, you're really looking if that person or those two or that team can relay a story. They can really be good storytellers and walk you through that mindset of why they're doing it or something like that. Do you mind just touching on some things that are, either big red flags or big things that really differentiate aside from just storytelling when you're on the pitch?
Yeah, it's a really good question. I think so what stands out, I think, is when someone can very clearly articulate how did one of their customers, whether it's an enterprise or whether it's just a consumer or it's a student or whatever the group is that they're selling to, is what problem were they having and how did this company solve their problem, and what do they do quantitatively or qualitatively that changed their life or their task or their workflow that much. And it's surprising how many people struggle with that. And I think telling us how that used to be solved in the past, so how do people used to do this behavior in the past and how do they do it now, is very interesting. And then going from that one place of here's one person, here's one company, here's one example, here's how the entire industry or all consumers can continue to interact with it and make it more interesting over time. That's one of the pieces where literally then I can see the vision for the company and get as excited about it as you are by fully understanding how are people dealing with this, just so I know it's not a problem only you believe is real, but it's actually a problem that everybody is seeing. And then backing that up with some metrics of saying, we built this and it was so important to them. It was such a big problem that, look, here's 50 people that spend X amount of time every day using the product because they care about it that much, whether it's a game or it's an app or whatever it is. So that stickiness becomes a very important piece too. Then articulating that you know enough about the industry and sort of where it's going. So a company that we were just evaluating, it's a very competitive landscape in healthcare where what the company was building, and it's based off of some regulation. And the fact that he knew sort of every regulation that was coming out and how things had changed and how big tech was thinking about the problem, how some of these smaller upstarts were thinking about the problem. Because if it is a valuable problem that you're solving for that customer group, then there's going to be a ton of people trying to address it and figure it out. But just being educated on knowing what else people are doing in order to solve it and offer that value, I think is helpful, because you have to realize that no matter how much VCs tweet and soapbox and pretend they're experts and everything, they really are not. And I think that's what's really important for the founder, to be able to guide them through the problem that I've spent 10 years or 5 years or just 2 years even learning about, and why it's such a big problem for these people, why they're willing to pay for it. And after I built this product based off of these findings, this is how much they're using it. This is why they care about it. Yeah, I'm threatened by X, Y, and Z, but this is why we'll survive, because everybody cares more about this than this, or this is where their shortcomings are. I think what I struggled when I was raising was, when we were raising venture capital for our startup, was more on, we didn't really have enough metrics to back up what we were saying. It was very vision-based. And I think that's where founders struggle sometimes when they're kind of going through the motions of going out there and trying to raise for a while. It's because they don't really have anything to stand on at that point. Then it's your bet against mine. It's you believe the world should operate like this. I believe the world should operate like this, but nobody else is using your product right now, so you can't really tell me that it's valuable. So I think that's where I started falling apart too, is I started trying to raise too early on the vision. So, but we can talk about it too offline if you want.
Yeah, I'd love to continue the conversation, but I think what I really pulled from it is that once you have a proper metric, it can really help tell that story from not just the passion or the feeling that entrepreneur can have. It really helps even the playing field for someone to really understand, what is the dollar and cents, what is the actual usage, what is the long-term viability of the project.
Exactly. Yeah. And I think the investment deck, since that's typically what someone will start with when they're looking at the business, the ones that do that well and that arc offer kind of the most value. of just like succinctly talking about what the problems are, giving me some examples, companies or issues of people that have, and then I can fully wrap my head around with that since I don't really know anything about it. So that's helpful.
Awesome. Thank you.
Yeah, of course.
If no one else has anything, I just want to do a quick follow-up to that one question. You mentioned that being a subject matter expert or having the understanding of the regulations or of the certain aspects of your project, of your vision. What do you do if you're really, fresh and it's really new?
So what we used to do at NYU when we were running this incubator, and this actually helps when you're building your pitch deck too, like if it's a new product that you're building and you're looking for like seed stage funding, is doing like more customer discovery and customer interviews, of trying to use the target of saying, I'm going to talk to, you're busy, right? So it's like, it's harder to kind of meet these goals, but even if you could do 5 to 10 a week of who your potential customer might be, and just understanding what are you using now, what are you solving for. That was one thing that we really screwed up in the beginning when we were launching our product, is we built it in a bubble. But I think I would have learned about all the competition just through those conversations. I would have been like, okay, this is what they're using. Oh shit, I never heard about that company. Let me go and research them. This is where, even though they use that solution, this is why it's not working for them. Or like, so you'll learn so much, I think, just through those conversations, where we have much better use of your time than sitting on Google all day. The other thing that we had done was we had set Google alerts for like certain words. So if we knew a founder was building, and we set an alert for that person's name. So if they did any PR, we would hear about it. In a heavily regulated industry, it's harder, I think, to set alerts. But like healthcare, since it's extremely regulated and there's always something going on, that just becomes a more important piece. So I think it depends on the industry you're building in. But I think having those conversations with customers will also surface some of that, of what's changing, what's there, and where the opportunities are.
I'll just jump in here. I had a quick question. So first of all, thank you, Kunal, for this great presentation. So this question is very short and sweet. Do you think family businesses are more attractive than non-family businesses for VC investing?
So it's an interesting question. So someone actually talked about that for the book, because Casper is a family business. It started off with him. His parents managed a kind of mattress company in, I don't know, somewhere in Middle America, and then he took that idea and realized it, and then went digital with it. I think the reason why it's not like it's more attractive or less attractive than one or another. I think the reason why a family business might have an interesting advantage is because there might be a supply and a defensibility of where you're getting your product from. It might have an advantage because now you're an industry expert and you've been operating this space for a while, so you can now guide the process. So we're investing much more in the founder in that case. Where it might get more complicated is if the management team is a bit all over the place, parents are involved, brothers and sisters, everybody's involved, and then you're concerned as an investor about a falling out between the family. Which, I mean, it doesn't happen, but you've seen some VCs who are pretty vocal against investing in husband and wife teams. And I think they've been proven wrong many times because those companies have done well. But it could just be a concern that a VC has. I don't really see it as like, I think it's how you tell the story around because we're a family business, there's not much downside. I think there's only upside, and it's just telling the story in terms of here's our advantage because we've been doing this generationally, or because we have these supply channels, or something like that. So.
Thank you.
A couple of businesses that are family. Yeah, for sure. Just a couple of businesses that are family businesses that I saw that recently got funded. One is called ClearCut, and I think it's a diamond business, and they have access to, like, it's a direct consumer engagement ring company. And I think because they have access to different product, it's helped them at least build it out. And then I think Casper is another example of something where Philip Krem got insights because of what his family had been building before this. Sorry, Zach.
No, I have another question, and it's always tough because I don't really know how to gauge it. But what's the aptitude towards trust? someone that has an idea and someone that's trying to build that, where do they start to lean on? How can they start to, air that idea out, but make sure that it still stays there? What are some things that, you suggest about trust?
So you mean like when you're having conversations with potential customers or
just
potential
anyone, like, let's
co-founders?
say, anyone, just like, hey, I have this cool idea or something like
I
that.
think it's better. I honestly think it's better to discuss it as much as possible, because I think it's like you're actually probably uniquely more well-positioned to actually build this company, because the person you're discussing it with has their own shit going on, whether it's a job or their own startup idea, and you'll toss it to them and they might give you some feedback on it that you hadn't previously thought of. So I think talking about it as much as possible is actually helpful, and like following a rubric for questions. So your feedback for each of those conversations is the same. But I wouldn't worry so much about trust, because I don't think anybody's going to go and start it. I wouldn't reveal, like, if there's something really, there's some secret sauce to your algorithm that you're building, or there's something that is really proprietary in what you have. But beyond that, if it's an idea and it's a concept and something you're going after, talk about it more, because you'll probably also get customers like that, right? So if it's something that you're solving for, or you'll hear about some competitor that they've used. So I wouldn't worry too much about someone stealing your idea.
Thank you.
If that happens, don't sue me. but I never have. I haven't seen it happen. I mean, obviously the famous one is Zuckerberg and Winklevoss, but I think for the most part, it's really, I think, rare. With NYU, we used to share ideas all over the place. But I think ideas have become more a dime a dozen now, and then like you can see like blogs where there's hundreds of ideas that people have suggested. So I wouldn't worry about it too much.
Got it. Thanks.
Any more questions, guys? Just jump on. Feel free.
I have a quick question. Kunal, thank you so much for joining us in this event.
Yeah, of course.
I just have a question about, let's say, your entrepreneurship venture. So can you just give a quick explanation how you started? You said that you kind of knew that you want to start something on your own, but like, as you said, also at NYU, there were a lot of ideas jumping around, and probably had, let's say, I guess with friends and things like that you started growing ideas. But was your path more like just out of the desire to start something on your own, or was it a combination of, let's say, having already an idea? Like, what led to going down that path first?
It was very clearly the former. It was much more I wanted to start something, and there's been multiple iterations of that. So in college, I tried to start like an import. In high school, I tried to start like an import-export thing where I was importing golf balls from China and then selling them on Amazon, and like, so small businesses that were never going to become big. Then in college, it became a little bit bigger vision where we tried to launch something called Bill Match, which was a modern day Venmo before that launched, and we had everything set up. And then we had someone start actually building it out, but we were very new to the entire thing. So we almost hired an agency to build out the product, but it was just a struggle in order to get that off the ground. And I think fast forward a couple of years when I launched Unfold and we actually built it and we partnered with the CTO, what we had done when we were leaving Charity Water is we had left with a different idea of what we wanted to build. And that idea came more from sort of some personal experiences and then some validation of discussing it with one another. We didn't do the customer discovery that I was talking about. And we left to build that, but then realized that we were operating in a very heavily regulated space, and it was something that we would need a lot more funding for, and it would take a while. So we ended up opting for a consumer play with the B2B angle as well for a media business called Unfold. And the premise of that was that we did customer discovery for it, and to simplify and dumb it down, it was really just Instagram for long form content, where the idea was that anybody in this chat, if now you followed me on this platform, I would share long form written articles to you. Not that I've written, but I found an interesting thing on customer discovery written in the New Yorker. So I could post it and everybody could follow that. We felt Twitter was too ephemeral, it was too noisy. Facebook was somewhere you posted intellectual articles. Snapchat, Instagram weren't really friendly for that. And we saw really good kind of consumer adoption early when people were using it. But it struggled when we started thinking about monetization and kind of building publisher relationships, given they'd all been burned by Facebook and kind of going down that path, and just realized it would take a lot longer. But with other people that I've seen, like it is for me, it has been, I think the ones that ended up taking off is because they've had inspiration with something. But you'll see like so many successful companies as a result of a pivot where they were started off with one thing and then had an idea as they were building it, and then used some venture dollars towards building that. So I think it works both ways. But for me, my own entrepreneurial thing has been very much chasing, I want to build a company, so let me go find out what that idea is. And I think being patient with that is also makes sense, where when you get finally struck with it, then you're like, this is what I want to commit to. I think having that inspiration, because it's going to take several years, is important, as opposed to just saying, let me go launch something. Because if in 3 months you don't really care about that problem, you're not going to really have the staying power to continue going after it. So
Thank you.
yeah.
Great questions, guys. Any last questions before I wrap things up? Okay, so the last question I really wanted to ask you, Kunal, it was, what kind of advice do you have for startup entrepreneurs during the pandemic? I know we have a few on this call right now, and what are some areas of opportunity that you and your team are eager to invest in, and especially from people who are straight out of their MBA programs, master's programs?
Yeah, for sure. So I mean, I think like during the pandemic, obviously it's harder to do customer discovery in person, but I think you do have an advantage of saying, okay, I'm just going to do quick 5 to 10 minute Zoom calls with different people and reach out to them, and you can offer them something. Right? I think that saves your time in traveling and getting things off the ground. So it does give you a focused area of spending an hour a day to really build something. I think there's been a lot of people also in companies who have now been building things on the side because they don't have to FaceTime the entire time or have to be sitting at a desk. So it's a unique advantage in that way. It's like a silver lining. For MBAs, I think like I've kind of spoken in a lot of the MBA programs and things, and it's interesting kind of seeing people wrestle with that decision of whether they go into a corporate job or they go and try to start something themselves. Like I think if you are starting something yourselves and you're interested in that, I think that's really impressive and you should stick with it, as opposed to, I think there's that feeling and that element of having to accept a job just because it's acceptable and you have this recruiting cycle and it feels like the world is coming down on you. But I've seen so many friends who have started companies during business school, work on it for a year or two. Some have taken off and they're doing it full time. Some failed, but I think they had a really interesting story to go and tell an employer at that point. So I think it's like staying kind of inspired to keep building it and chasing it if it's something that's interesting to you. And I'm happy to help, and you can reach out to me whenever you want. And I'll keep putting out stuff out there from VCs and founders who might share some of those stories too. And I'm happy to chat whenever you guys want. So, but it was really great to be here, and I appreciate you guys all being so engaged and sharing such good questions. And I'm happy to keep the conversation going.
So if everyone can give Kunal a round of applause, and we can
Thank you.
Themselves, or yeah.
It's funny seeing it on mute. Yeah.
So thank you so
I
much.
appreciate it, guys.
Yeah,
Yeah,
thank you so much. And yeah, thank you all for joining us, and have a great holiday season. Yeah.
Great. Thank you, everybody.
Thank you, Kunal.
Thank you.
Thank
so
you.
much.
Thank you.
Looking forward to the
holidays.
book.
Thank you.